Hello, everyone. I'm Laura Kornhauser.
And I'm Shannan Herbert.
Thank you so much for joining us today. In this 30-minute session, we'll talk to you about why inclusive finance is not ready for the accelerated pace of changes and what we need to do to get us there, and in particularly how technology, if applied properly, can be used to drive global impact. The focus of our conversation today will be on lending and in particular, access to capital. So let's dive in. As mentioned, I'm Laura Kornhauser. I'm the co-founder and CEO of Stratyfy. I have 2 decades of experience in finance and technology, always focused on how advanced methodologies for managing and mitigating risk can be deployed to provide fairly priced financial instruments to a wider set of consumers.
And
Shannan, over to you.
Thank you. And I'm Shannan Herbert, EVP of Inclusive Credit with Stratyfy. I have more than 2 decades of experience in the commercial banking space with a specific focus on community development finance.
And we lead a mission-driven global team focused on driving inclusive finance while also helping financial institutions better manage and mitigate risk. We feel that one cannot be done without the other, and our team is dedicated to helping do that by providing tools and technology that enable our customers, financial institutions, to understand the real risk of their potential customers, and more specifically, potential borrowers looking for access to capital. So a little bit about what we'll be walking through today, if we can pull up the agenda. So we all know that technology has the power to help, but only if applied properly. That's with diverse teams who understand the risks of said technology and have a clear understanding of the impact they're trying to drive, and if that technology is fundamentally transparent and enables you to understand how it works. So that's what we believe is the solution. But first, we'll talk a little bit more about the problem, the opportunities that technology has to fix this problem, the potential risks with that technology, and then a little bit more about why we think the inclusive finance sector is not quite ready for this accelerated pace of change and what needs to happen to make that different. So with that, Shannan, let's dive into the problem. Why are we here, and why is this a problem that we see in the world and in the US specifically?
Thank you. We see this problem because the system was not designed to be inclusive. That's just the bottom line.
Mm-hmm.
The creators of the system did not anticipate a multiracial or multicultural society that would be accessing products or the system, right?
Mm-hmm.
We've all been trying to fit into this box that was not designed to have us in, have us in
To
there.
allow you in, yeah.
To allow you in, right?
Yeah, yeah.
We've all been trying to fight our way into this box and fit into this box, but it's not working. It's not working for everyone. And so to achieve real change, we need to figure out how to dismantle this box, because the progress that we're making, while it looks great, it's been slow. And technology has the ability, and we're seeing it, technology has the ability to outpace the progress that has been made, that is being made, and completely reverse some of the gains that we've made over the last couple of decades. When you think about the banking system, for instance, in the United States, and how our economy was built on the premise of slavery, right? Banking
Mm-hmm.
system was open for white male landowners who also owned slaves. Slaves were used as collateral for loans. And even after slavery ended, policies and laws put into place to continue to restrict access. So Black people, for instance, in this country have never had control of their economic destiny.
Mm-hmm.
These are the things that we need to change, because while we talk about the problems here in the United States, these problems are global.
Mm-hmm.
And without real policy, without real advocacy behind what we're talking about, we're only going to go backwards.
Mm-hmm. Absolutely. And we both know that technology has a real opportunity to help fix or help address these problems, right? As you see on the slide here, there are vast differences in the ways that people of color are treated by our financial system in the access that they are provided to fairly priced capital that can be used to help the business that they've started, that will not just impact them but also impact their community, to help them buy their first or second or third home via mortgage. And that lack of access, which is based on I would say old ways of measuring creditworthiness, is a real problem that technology has a real power to fix. With technology, and in particular advanced modeling technology or machine learning and AI, we have the ability to look beyond traditional, what has been thought of as traditional indicators of creditworthiness, to look to the true indicators of creditworthiness, and find those people that may, based on 1 3-digit score, not look like they would be a great customer for a financial institution, but in fact, they repay their obligations and they will repay their debts. So that's one real opportunity, the ability to look beyond these traditional indicators of creditworthiness, because, as this slide shows here, 80% of Americans have never defaulted on a credit product, yet less than 50% have access to prime capital. Prime credit. So they don't have that right 3-digit score, but they still would be really good customers. They still would repay the loan, which that's ultimately what the financial institution can care about. And technology is a real opportunity to fix that. The other thing that technology can really do to help is help in this problem is innovative technology can help scale and measure impact. So technology can help measure and monitor the impact that programs are having, not just lending programs, but other programs as well, and also scale something that's good. So if you have something started that is having a positive impact, technology can do a lot to help scale that impact. Now we'll get into this with risk, but if you have something going in the wrong direction, technology can do a lot to drive that further and deeper in the wrong direction as well. So that benefit from a scaling standpoint has to ensure that technology is transparent and fair and inclusive to start with. This is something that we're really focused on at Stratyfy, is that level of transparency and visibility into how exactly, in our particular case, machine learning is working, models are being built, what is being learned from data, such that we can ensure that if we're scaling something, we're scaling the right thing. That's for sure. So transparency we see is absolutely essential as a characteristic of technology that is going to fix or address these problems. And that is in large part because of the bias that is ingrained into our financial system for the reasons that Shannan mentioned at the top of this call. Our financial system has been racist since its beginnings, since its very, very roots. And that systemic racism has been, and that systemic inequality has been built into our system, and now it's built into our data. We often say at Stratyfy, it's not a question of if your data is biased, it's a question of how. And if we're not applying the right technology on top of that data, right? If we're putting black boxes where we don't understand how they're working on top of biased data, then all we're going to do is further propagate forward the biases of the data, i.e. the biases of the past and unfortunately the present. So that is such a huge risk in advanced technology or AI machine learning being applied. Shannan, can you talk a little bit more about on this topic of biased data? It goes beyond what we have in the data into what we don't have in the data. Can you talk a little bit more about that?
Yeah, so I want to go back to something though. When we talk about access to capital, last year, so 2022, the Federal Reserve Board published a study looking at mortgage approval disparities. And what they found was the underwriting played more of a role in the approval and denial of credit, but that underwriting was biased.
Mm-hmm.
And so while it wasn't as specific, and this doesn't mean that it doesn't happen, it wasn't specifically overt discrimination that caused the number of Black and brown borrowers to be overwhelmingly denied for mortgage loans. It was definitely tied to the way that underwriting was done at these financial institutions. So you think about how the underwriting is done and who the underwriting standards and guidelines were designed for.
Mm-hmm.
And who's coming into those financial institutions now to apply for loans? Do they fit those traditional underwriting guidelines? The answer is no.
Mm-hmm.
Does that mean that they're bad credit risks? We don't know because we don't have enough data to be able to say definitively that these folks that are coming in with these characteristics are riskier. These folks that are coming in with these characteristics are going to default on their loans. We don't know
Because they've never been given a chance.
That's right. They've
Yeah.
never been given a chance. They've never been seen. The data does not see
Yep.
these. So if the data doesn't see these individuals and you're building a model with that data, it's never going to see those individuals. So you're already building a model with bad data.
Mm-hmm.
Your data may not see me. And so this is where we need to have real conversation about the data that's going into these models, the scientists and the engineers that are building the models and what they're seeing, and where we see these disparities start to make changes. But we can't continue, as you said, we can't continue to run with a system that has not worked for everyone, and then claim that, well, technology is going to fix it, but we don't really know what's going on behind the scenes from a technology standpoint. And so it's hard to say or hard to stand on the technology is going to fix it when we know that the data being used to build these systems does not include everyone that needs access to capital.
And unfortunately, too many technology companies out there right now do not want to provide that level of visibility or transparency into exactly how and why they're doing things, because they don't want to expose their IP and they don't want that to be potentially taken. And while a lot of those fears and concerns are warranted, that again, in this place where you're using advanced technology, and here we're talking about machine learning technology in particular, used to build models that predict the likelihood that someone is going to default on a loan, for example. When you're using this technology for these high value, high risk use cases that truly impact someone's life, you have to have that level. You have to provide, as a technology company, you have to provide that transparency. And as a user of that technology, i.e. a lender, you have to demand it from your providers. You have to demand it from your providers. Otherwise, you can't ensure that you're getting anything close to fairness, anything close to inclusivity without that level of transparency and visibility.
Absolutely.
Yeah. So moving on to how we started the call, Shannan, why do you think that inclusive finance is not ready for the accelerated pace of changes? And what are the key hurdles?
Well, I think we have to start with the word inclusive.
Yeah.
I don't think that everyone is on the same page with what it means to be inclusive. How many folks that are in positions where they can actually deploy capital can say with 100% certainty that they understand the needs of their communities, all of the needs, that they understand the cultural differences and nuances within the communities that they serve. Many folks can really say that. And so I think that until we understand how community works, who's in our communities, what those needs are, and really listening. And I'm not talking about telling folks, well, here's the product and just take it or leave it, but really practicing, compassionate listening, getting to know folks and what their needs are. We can't say that we are being inclusive. We have not been inclusive because there are still so many people that are going without.
Mm-hmm.
So many people are going without. I think about the project that was just done in Waterloo, Iowa, for All In Grocers.
Mm-hmm.
This community, predominantly Black community, had lacked a healthy food option, a grocery store, for decades, decades. It took 7 years to get this project off the ground. Local banks would not finance this project. It took outside capital providers to come in to finance a grocery store for the residents of this town, this community in Waterloo, Iowa.
Mm-hmm. Mm-hmm.
But if you have folks that are there, local folks that have basically taken their hands off, then I would argue that no, that is not an example of inclusive financing.
That is an example of someone coming in to save the day because the system is broken.
That's right.
That's what that's an example of. And thankfully, there was that organization to come in and save the day. But the system should have funded that business.
Absolutely. The system should have seen the problem and said, what
Absolutely.
can we do to step up and help?
Absolutely. 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 And I think this goes to what we've been talking about at the core of technology that is being built to help drive efficiencies and scalability at financial institutions. Again, technology that often leverage advanced modeling capabilities or machine learning. These technologies and these models, as Shannan mentioned earlier, who's creating those models, right? What do those teams look like? Those teams are not, I'll just be very blunt, are not diverse enough. And that diversity is not just in gender, not just in ethnicity, but also in viewpoints and backgrounds and way of thinking. And too frequently we have sameness in those teams that are ultimately building technology that then is scaled and has a multiplier effect from an impact standpoint. And we need to address that, and we need to stop that. And then the other thing that we unfortunately are seeing out there in the world right now is a lack of consistency in how impact is prioritized. There is a certain set of organizations and individuals that understand that impact is the right thing to prioritize because it's not just the right thing to do, but it's also great business. And then there are others that have a lot of talk about impact, but not a lot of action. And ultimately, when it gets down to what gets funded, what gets invested in, what gets prioritized, impact is not front and center. And it is not even a consideration. Again, even though we have proven through our work at Stratyfy that it's not just the right thing to do, it's also great for your business. Not enough people know this yet, and not enough people recognize this. And these are the types of changes that are really necessary in order for us to get, inclusive finance as a, I'll say, concept and a belief system and a hope, meeting the pace of implementation and acceleration of technology changes. And then, I would be remiss if I didn't mention more about Stratyfy here, because this is, again, core to our very existence and why we set out, why we started the company now 6.5 years ago. We are focused on delivering to our customers, financial institutions, tools and products that help them not only identify a creditworthiness of borrowers in a way that looks beyond traditional indicators of creditworthiness to assess the real risk or true risk, as we often see, of both individuals and small businesses. This is our credit risk decisioning solution, again, with transparency at its core, and it's also built to be accessed by not just data scientists, but also accessed by people that have other skills and other backgrounds, and understand both have a high level of credit and risk expertise and really understand the customers they're serving. That's how we built our products, so that they could be accessible by larger group of individuals. And then our other core product offering we call Unbiased, which is focused squarely on bias detection and mitigation, allowing institutions to uncover bias in their models and decisions proactively, to find these risks before they become problems, to understand exactly what is driving those risks, so that importantly, they can move to step 3, which is undo. Proactively mitigate the bias that is embedded in their data and past decisions, such that they can make better decisions and more fair decisions going forward. We applied this unbiased product to HMDA data. So this is mortgage data that's publicly available, to look at the biases that exist in both automated and manual underwriting processes for mortgages. And the results that we found were really astounding. We looked at just 1 year of data. This is data in 2021. We're looking at just 1 year. And we found that there was a very, very high percentage of Black applicants, 10% of Black applicants that were unfairly or unjustly denied. So let me be very clear about what I mean by unfairly and unjustly. These were applicants that if you will, the data about them looked just as good as their counterparts. But they unfortunately were treated unfairly, despite the fact that they looked just as good as their white counterparts. They were 10% more likely to, or 10% of applicants were unjustly denied that were Black. And what this translates to is really astounding from a number standpoint. It translates to just over 1,100 individuals that were applying for an average mortgage amount of just less than $350,000 that were, again, unfairly or unjustly denied in 1 year. In 1 year. And if you multiply those two numbers together, you find that just under $400 million in capital, just under $400 million in capital in loans for homes, one of the primary ways in which wealth is built in the United States and in other places. That just under 400 million of capital or credit was unfairly not given, again, unfairly not given to Black borrowers in 1 year. Like, let that set in for a second. In 1 year. We take this and we multiply it, and it's no surprise that we're in the awful place we are right now with the racial wealth gap. And this is a center to how wealth is built, and a problem that we can address with the right, transparent technology that checks for bias, that ensures fairness. We can take these numbers and we can flip them around the other way, which leads me into some amazing work that we're so honored to be part of at Stratyfy. Shannan, can you tell everybody a little bit more about Underwriting for Racial Justice and what that program's all about?
Sure. So Underwriting for Racial Justice is an initiative being led by the Beneficial State Foundation, founded in 2021. We recently launched a lender pilot program where Stratyfy is a technology partner. We'll be working with 20 lenders over 2 years using technology, innovative technology, to help them change the way that they underwrite. So this looks at risk, this looks at underwriting guidelines, and where lenders are getting it right and maybe where they're not getting it right. Right. And so the ultimate goal is to deploy capital. We want as much capital out there as possible. But then the other thing we want to do is change the narrative around risk and how we have historically looked at risk and how we should be looking at risk based on changing demographics, based on changing profiles of borrowers, based on changing needs of borrowers, and based on the collective goal we have to build wealth within our communities and ultimately close the racial wealth gap. We cannot get there by doing the same things that we have been doing historically. It just won't work. That's just bottom line. What we've done historically has not worked for everyone. It will not work going forward. So what are these new methods that we need to introduce to the system so that we can start to break down some of this stuff that has not worked and build it into something that will work for future generations? So what we're going to provide is a risk score for our lenders in the program, recommendations for changes to lending policy and underwriting guidelines, and then also quarterly check-ins with the lender group to let them know how they're doing, how your new underwriting guidelines are working within the community, and what kind of impact you're having across the board, and if it matches, what your expectations were. This is a great way, I think, to show how innovation can drive it's also a great way to connect communities to capital. So where you have between this level of distrust between financial institutions and communities, for instance, this is a very transparent way to build that trust within your community.
And do so in a way where, you are also doing it with a community of other lenders that are committed to the impact that you're looking to drive, right? Or that each of these individual lenders is looking to drive impact, and they're looking to drive it all together. And the community aspect is being extended to, everybody that's participating in this underwriting for racial justice program, with shared insights and learnings across the group, as you mentioned, in that community of practice, which I think is so unbelievably powerful. And it's this kind of industry collaboration in concert with advanced and innovative technology that will help us hopefully soon have a very different answer to the question that we started this session with, and help us feel strongly that inclusive finance is or can be ready for the accelerated pace of change in technology. It's these kinds of collaborations and initiatives that will move that needle, and will move that needle really meaningfully. So with that, thank you so very much, everyone, for spending your time with us. If you'd like to learn more about our groundbreaking Underwriting for Racial Justice initiative, or more about Stratyfy and its product offerings, or you just want to talk about these topics more, which clearly both Shannan and myself are extraordinarily passionate about, please, we encourage you to reach out, to connect. We'd love to continue the conversation, and with the collaboration and coordination of folks like yourselves that are listening to this session, who are clearly passionate about this topic as we are, we can flip this on this head and make sure that we are the keeping up and staying ahead of the pace of technology, and leveraging all of the benefits that advanced technology, and in our case, advanced modeling technology for credit and risk, can and has to offer if used properly. So thank you so much, everyone, for your time. Enjoyed it with you, and we hope you'll reach out to connect afterwards.
Thank you.
Thank you.